For the first 3 years of my trading career, I thought my problem was picking the direction of the trade. I would spend hours analyzing the charts, get stopped out by a single pip, and then watch price scream straight into my take profit. But without me, it took me 8 years losing thousands of dollars and blowing accounts to realize a brutal truth. Your strategy is not broken, your entries are. Every single entry mistake you make comes down to 5 specific decisions. Which chart you look at, which level you mark, which direction you trade in, when you actually pull the trigger, and where you hide your stop loss. So in this video, I'm breaking down the exact 5 mechanical entry rules I never break. Fix these 5 and you can double your win rate over the next 30 days without changing your core strategy. Let's start with the biggest lie in the retail trading: top-down analysis. When I first started day trading, every guru on YouTube told me the exact same thing. You must do top-down analysis. Start on the daily, go to the 4-hourly time frame, refine on the 15-minute, and enter on the 1-minute chart. So that's what I did. I would wake up at 5 a.m., mark my daily demand zones, draw my 4-hourly support lines, and sit waiting for the price to tap that level. And you know what happened? 2 things, and both of them destroyed my account completely. First, half of the time price would tap that massive daily level at 3 a.m. when I was dead asleep, or at 2 p.m. when I was busy. By the time I opened my charts, the move was completely gone. Second, when I was at the desk when the price tapped at that higher time frame zone, I dropped down to the 1-minute chart to find my entry, but on the 1-minute chart, the price would give me 4 fake outs before reversing in my direction. I would buy, get stopped out, then I would buy again, and then I would get stopped out again. Then the price would finally make the move without me. Are you getting this, guys? So the internal struggle was exhausting. I felt like I was working a full-time job, staring at 4 monitors, feeling like an idiot because the market always seemed one step ahead of me. Then I had my epiphany. I am a day trader, not a swing trader. A day trade only lasts between 30 minutes in a couple of hours. So why was I letting a weekly or daily candle that takes 5 days to close dictate a trade I only plan to hold for 45 minutes? It's kind of like checking the 5-day regional weather forecast just to know, like, when all you need is to know whether it's raining outside in front of the door right now. You don't need what is going to be 5 days later. So the rule is simple. Stop looking for your entries on the higher time frames. Find your levels and take your entries on one single time frame. The 15-minute chart if you're a day trader. The 15-minute chart, because it's a sweet spot. It moves fast enough to give you 1 to 2 clean setups every single day, but slow enough to filter out the random market noise that drains your capital on the 1-minute chart. From now on, close your daily chart, close your 4-hourly chart, close your 1-minute chart, open your 15-minute time frame. You identify the current session highs and lows, mark your clean 15-minute supply and demand zones, and execute your trade right there on the exact same chart. 1 time frame, 0 conflicting signals. Now, once you are on the 15-minute chart, your next question is, which levels do I actually draw? So, because if you draw every level you see on the chart, you're walking straight into the second trap. Back in 2018, my charts looked like a spider web, I had a support and resistance lines drawn from the 3 weeks ago, order blocks from the last Tuesday, and the trend lines stretching back 1 month ago. Whenever price moved, it was always hitting some line on my chart. I thought having all these levels made me look professional, but in reality, it just paralyzed me. I would see a great long setup, but then I would look at the left and say, hold on, there's an old resistance level from 2 weeks ago. I cannot buy here. So I would hesitate. Price would skyrocket and I would miss the trade. Or worse, I would short into a powerful bull run just because the price touched an old line from 14 days ago and get blown out instantly. I felt like no matter what button I clicked, I was literally always wrong. So my breakthrough happened when I studied how institutional order flow actually clears the book. The older the level is, the more irrelevant it becomes. Price has already processed those orders and moved on. The market doesn't care about a random 15-minute week from the last months. It only cares about where liquidity sits today. So it's kind of like trying to use the last month's grocery store coupons at the checkout counter like today. They're already expired and the cashier doesn't care that they worked 2 weeks ago. The rule: never trade a level outside your reference point. As a day trader, your reference point is the previous day's candle. You only mark supply and demand zones that sits inside the highs and low of yesterday's range. Nothing before yesterday exists. That single filter eliminates 18 useless lines from your screen and leaves you with 1 to 2 high probability levels price can realistically reach today. Here's the exact routine. Every morning, mark the previous day high and previous day low. Look strictly between those two boundary lines on the 15-minute chart. Identify the single unmitigated supply or demand zone inside that range. If a level is outside that boundary, just ignore that. You only have a clean chart with only 1 or 2 valid zones to focus on. Now, once price approaches your zone, you have to decide which direction to trade. And this is where 90% of the retail traders get stopped out because they confuse the trend with something far more important. We've all heard the golden rule of trading. The trend is your friend. For years, I treated that like a gospel. If the daily or the 4-hourly chart was in an uptrend, I would look for buys. One day I was trading the Nasdaq. The daily chart was in a massive bull run. The market opened with an aggressive sell-off, a deep pullback. I kept looking at my macro chart saying the trend is up, so I must buy the dip. I bought. I got stopped out. I bought lower. I stopped out again. I bought a third time with a bigger size because it is at the major trend line. Boom. Stopped out a third time. I lost $3,200 in 45 minutes, guys, trying to buy in an uptrend. I remember closing my laptop, staring at the wall, feeling sick to my stomach. I followed the rule. Why did the market punish me? That was the day I learned the vital distinction. Trend and momentum are not the same thing. Trend is the macro picture, where the market has been over the past months. Momentum is where the immediate impulse of the money is moving right now. If a market is in overall uptrend, but currently in a deep 15-minute pullback, the immediate momentum is aggressively bearish. Buying into that pullback means you're stepping directly in front of the falling piano just because the building is tall. So the rule: stop using the macro trend to enter with an immediate momentum. As a day trader, you don't get paid for where the market goes next week. You get paid for capturing the next 30 to 50 points in the next hour. You must trade the direction of the immediate 15-minute momentum impulse. When you sit at your charts, look at the last 3 to 5 15-minute candles. Ask yourself, who is displaying aggressively displacement right now? Are the expansion candles green or red? If the price is aggressively pushing down into a level, do not blindly buy. Wait for the downtrend momentum to exhaust and clear 15-minute bullish impulse to print. Before entering in that direction, trade the impulses that is active right now. Now, once the momentum aligns with your level, you reach the momentum of truth, pulling the trigger. And this next rule is the most controversial thing I teach, but it's the exact reason my win rate exploded. This rule sounds completely reckless at first, but it's actually the safest thing that you will ever do with your trading. For a long time, I was terrified of losing. So my rule was never enter at the level until you get a confirmation. A double bottom, a hammer candle, or a 1-minute shift of the market structure. Here's what it actually looked like in reality. Price would tap my 15-minute demand zone. I would freeze, waiting for the confirmation. Price would start rallying from that level. It would break a minor high, form a bullish engulfing candle, and print the confirmation. By the time I finally felt safe and clicked buy, price was already halfway to to the take profit. Because I entered so late, my entry price was terrible. My stop loss had to be placed all the way below the original swing low, making my stop twice as wide. My risk to reward ratio dropped from clean 1 to 4 down to 1 to 2 or 1.2. And the worst part, the market would do a small normal retest, hit my wide stop, and then rape straight to wide take profit. Waiting for the confirmation was costing me thousands of dollars in a lost risk to reward ratio. I realized confirmation does not give you an edge, it only gives you an emotional reassurance. And the market charges you an enormous price for that false feeling of safety. The highest paying, cleanest setup, often the tap at the level and launch violently without ever giving a second chance to enter. It's kind of like waiting for the train to leave the station and reach 40 miles per hour before you decide to jump on into the board because you wanted to confirm it was moving, So the rule, never wait for the candle confirmation before you enter your level. You trade the level itself with a preset limit order or a mechanical trigger. The moment price touches the level, not after the move has already left the station. When your 15-minute level is established, place your limit order right at the proximal edge of that 15-minute zone. Define your stop loss mechanically before price even arrives. When the price taps into that level, the trade is filled automatically. No hesitating, no second guessing, no waiting for the candles to close. That brings us to the fifth and final rule. Because entering at the level is only half of the equation. If your stop loss is placed at the wrong spot, none of these matters. When smart money concepts and order blocks trading blew up on the internet, everybody became obsessed with 3-pip, 5-pip sniper stop losses. So they could spot like 1 to 20 restored screenshots on Instagram. I fell for that trap as well. I would place my stop loss exactly 1 pip below my entry candle or right under the order block wick. And what happened? I would lose 8 of 9 times in a row by a fraction of a pip, get completely tilted and then miss the one trade that actually ran. I was right on the market direction 70% of the time, but my win rate was under 30%, even under 10%, because my stop loss were sitting right in the middle of a standard market breathing room, The turning point came when I stopped trying to look cool on social media and started focusing on making consistent withdrawals. The market has a natural spread, volatility, and liquidity sweeps. A stop loss that survives ordinary market noise is worth infinitely more than a tight stop loss that looks impressive on a screenshot. It's kind of like parking your car 2 inches away from a highway lane. Technically, you're off the road, but the first gust of a wind is going to take your mirror off. Give yourself a buffer. The rule, never let your stop loss sit where ordinary market noise can reach it. You enter deep into the golden zone between 60 to 80% retracement level on the 15-minute impulse leg, and place your stop loss beyond the true structural invalidation point, not a tide under your entry candle. Here's the exact mechanical execution. Pull your Fibonacci tool from the start of the 15-minute impulse leg to the swing high. Only set your entry orders inside the 60 to 80% discount zone. Place your stop loss safely below the 100% origin point of that impulse move. So, plus a small buffer for a spread. By entering deep in the discount zone, your risk remains small, your reward remains high, 1 to 3 or 1 to 4 trades, and your trade has the room it needs to survive standard market liquidity sweeps. 5 rules, 5 mechanical decisions, 1 single time frame, the 15-minute chart, trade only inside yesterday's reference range, follow the active 15-minute momentum impulse, execute directly at the zone without waiting for confirmation, enter in the 60 to 80% golden zone and hide your stop loss outside the market noise. The last is applied for the breakout trades, not the supply and demand levels that we have talked in the rule number 4. When you eliminate the guesswork on those 5 decisions, your win rate stabilizes immediately. But entries are still only half of the complete mechanical system. You still need exact session timing, risk management rules, and trade management protocol to become a consistently profitable trader. I've mapped out the full step-by-step mechanical trading framework, including real chart examples of these 5 entry rules in actions inside our free mechanical entry blueprint. Click the link in the top comment or the description below, grab your free copy and apply it on your charts tomorrow. I will see you inside.